Now presenting COO John Davis for FlexShopper.
Thank you. Okay, thank you. FlexShopper, who are we? So on the NASDAQ, FPAY. So think of our company as a combination of a Shopify and a lending tree. So what we do is we have a website that has all sorts of durable goods, and we provide lease-to-own financing for that. So similar to what you would see in a Rent-A-Center or an Aaron's, but instead of having bricks and mortar, we actually will fulfill that through a website. We also will provide that same financing for partners. So we have exclusive partnerships with companies like Monroe Tire, Mavis, really a lot of in the automotive space, some retailers on the furniture side, the appliances side, anything that is durable goods. And really the big thing is that this is a product that really caters to that underserved credit consumer. So the customer that doesn't have the kind of liquidity that they could just go and apply and get approved with a Synchrony credit card or a Citi credit card. Safe harbor statement, you can read more about that on our filings and our press releases. So talking about how the business has done. So dramatic increase in the store count that we have our products available. So 250% increase in 2024. Pretty significant increase from 2,500 to almost 8,000. That increases in the number of approvals that we have, expense in gross profit, EBITDA, and operating income. And the greatest thing about this business is it's good and bad. When we put into new relationships, it actually has a seasoning. So a lot of the revenue is actually going to be deferred. So we actually will have tailwind in 25, even if we add no more partners. Additionally, the way that we account for our lease revenue is actually accrued over the life of the lease. So big originations in December, through the holiday season, that revenue is recognized over, 2025. So, but with that, we are still increasing both our store count as well as growing on our marketplace. So financial highlights, net lease revenue was $107 million in 24 versus 92. Overall revenue was 140. Gross profit, 40% growth. Adjusted EBITDA, $33 million, highest in the history of our company. And as we look at 2025, some key things that we're looking to do. We are expanding our offerings to not just the traditional retailers like a Monroe or a Mavis, but actually going to product providers, so direct to manufacturers like an LG or a Samsung, and Ashley Furniture, companies that actually supply products that are then distributing to retailers and providing our financing. And again, our financing caters to that third of the United States that doesn't really have a lot of access to credit. It's sub 640 FICO score. And as the economy starts to get more challenged and the banks pull back, it actually creates more customer flow into our space, which we're really happy to work with. Another big opportunity that we have is pursuing bank relationships. So with a lease-to-own, you can lease tires, but you can't lease an oil change. It has to be durable goods. With a loan, you can actually provide that same kind of financing with the same sort of economics to a much broader range of products and services. And we used to have a bank partnership a couple years ago. They exited the business, but we're pursuing a couple that in essence expands the kinds of products and that really kind of increases the TAM that we have available to us. With that, we are projecting another 17 to 30% increase in gross profit year over year in 25 and adjusted EBITDA of 40 to 45 million, which is a 20 to 35% growth rate. So about FlexShopper, we have two channels. Channel one is this B2C. So we have a website, FlexShopper.com, where we will source customers through digital marketing. We'll source product through either retailer partnerships. We have a partnership with Best Buy, for example, integrated to be able to do in-store pickup fulfillment, as well as go into manufacturers, wholesalers, and distributors. And we not only make revenue from our lease business, but we also make a retail revenue profit as well. We have a margin of an average 20 points on that. And then on the B2B channel, these are these partnerships where we're at point of sale, where we get new customers in. And the best thing about having this marketplace, which is unique to this space, is that a customer who is acquired through our B2B channel, which represents roughly 65% of our new customer originations, will then be marketed to our B2C channel and have repeat customer dynamics. And the best thing about a repeat customer from a loss perspective is the payment rates are much better because they've proven that they've made payments with you before, otherwise we wouldn't lend to them. Asset light model, so all the products that we have on our B2C marketplace is either drop shipped or we are fulfilling with partnerships at our distributors, manufacturers, distribution centers. So no inventory risk, very low CapEx requirement, and it's as scalable as we can find customers to make purchases. Looking at the average customer, so they're lower income, $3,300 median monthly income. They're a little older than you would potentially think. They skew female, and even though it does skew renter, there are a significant number of homeowners. So we will get the kind of purchase behavior on furniture, televisions, things to actually furnish a home that these customers really want to buy. Our technology, so we have different portals that we've set up, either through integrations with third parties, third-party waterfalls, or we have mobile-friendly technology where a customer can apply for this financing on their own device, scan a QR code at point of sale. The application, unlike the olden days in sales finance where you'd have to go and apply with the desk, and the agent says, sorry, you're declined, the customer can do this in the privacy of his phone. They get approved instantly. They then get a virtual card that is instantly delivered to their phone, and then they use that to check out at point of sale, and the purchase goes right through their Visa, MasterCard network at the tire store. So the key parts of the economics of this business, one, you want volume. You need to have sales. Two, with a financing type product, you can give money away, that's the easier part, but are you actually collecting it? And one thing that we've really worked hard on over the past year is improve our bad debt ratio. So our bad debt is 24% in 2024. Now, if you think about this from a credit spread perspective, though, we charge, in essence, 100% on our financing. Again, this is for that subprime customer. We'll lend $1,000 out. We will charge $2,000. We'll get $1,500 back, 25% default rate. So from a credit spread perspective, we're making $150 on that $100. And that's on our B2B channel. On our B2C channel, where we're getting a retail margin, we sell $1,000, we buy $800, and we're making that $1,500. So we're actually having a much stronger IRR because we're buying that $100 paper at 80 cents on the dollar. Now, a part of this, and this is something that I've been commenting on some of my one-on-ones, especially on the digital side, fraud is a big issue that a lot of our competitors have. We have worked very hard in combining a lot of different disparate data sources to be able to really triangulate on what the fraud components are and be able to prevent both third-party fraud as well as first-party. And first-party fraud would be defined as, they are who they say they are, but they have no intent to pay you back. What this does is it looks at a bunch of third-party data sets. It looks at the traditional ID verification that you would get from a credit bureau. It looks at the device. Has that device, that IP, been used for nefarious activities in the past? We're using instant bank verification where we're downloading bank statements on a select customer through a plaid type interface. We're looking at what the customer does on our site. So what kind of cart do they want to try to finance? If it's 5 iPhones, then it probably is a bit more of a dodgy sort of transaction than if somebody's buying a refrigerator. how quickly they interact with our site. If you see that the email was filled in within half a second, they're probably doing a cut and paste or it's a bot. So all of that gets triangulated into a machine learning model that our fraud team has developed, which then either puts lots of friction on very questionable customers or fast tracks the good customers that have very low risk, which has helped in getting that bad debt down from the 30s to the 20s. So, and I talked a little bit about this model. So that initial cost of 1.0, expected return of 1.5. This B2C channel, the beauty of it is the repeat dynamic. Nobody else in our space has this kind of marketplace available. So if you look at some of our competitors, it'll be Progressive. It will be Acima, which is a part of Upbound, which is owned by the parent of Rent-A-Center, Catapult. None of those companies have a marketplace, so their repeat rates are generally 10%. Our repeat rates are 50%. And in fact, if you look at the customers who are eligible, so if a customer goes bad, that 25%, we're not going to relent to them. So as a percentage of eligible customers, we have a very, very high repeat rate. That liquidity is treated just like you would see on a credit card. So credit line increases, lowering prices, promo rates, all those types of same sort of portfolio management techniques we use on our spending limits that we offer for future leases. And then on the B2B side, what we've found is merchants who put in our financing product have a 37% increase in financed orders. So it will range, depending on the kind of retailer and type of products that they sell. But because that underserved piece are in essence sales that are dropping to the floor, especially for retailers that have larger SKUs like a tire or an appliance store, this kind of full financing stack that really covers that lower FICO score is very attractive to these retailers, and it's become much more mainstream. You can walk into a Best Buy, you can walk into a Rooms To Go, you can walk into an Ashley Furniture. You see this kind of product available to make purchases, and the retailers, they want to sell more things, especially now. So this kind of offering is really taking a lot of traction as we go and talk to different potential new partners. So looking at some of our growth strategies. So, we're always looking to grow our total addressable market through, different types of payments, different types of technology, getting more efficiency on our website and bringing marketing in, on our digital channel, because it is digital marketing, our CAC is roughly $150. But because it has that repeat, the IRR is very strong. But it is expensive and it takes capital, so we're always looking to create more efficiency there. And then, increase the store count, try to continue that trend on that 250% growth rate that we had on stores in 2024. So if you look at, this is, the typical credit stack. So you'll have the prime offering here. So this prime promo rates, this will be your Synchrony Finance, your Citibank, private label credit cards. You have to be a healthy credit score to be able to get approved for that. You're going to get a long-term no interest rate, but your go-to rate will probably still be in the 20s when it's all said and done. This secondary piece here is actually significant. So if you look at companies like Signet Jewelers, they have a full credit stack, and a lot of their balance of sale doesn't come from this prime piece. It actually comes from the secondary piece. FlexShopper is here, and then we actually have a current partner that actually sits below us. So since we have a particular required rate of return, there are other companies that are in our space that want the volume. They don't pay any marketing fees. It's free customers to them, but their rate of return requirements are lower. It helps us because if we can make 20 points of margin on a sale that would normally decline, that's a benefit to us. So as we look at trying to enhance this credit stack, get more thickness here, get more thickness here, get more thickness here, then what happens is, today we'll convert roughly 50 basis points of traffic that comes to our website. If I can increase that to 3-4 points and look more like a typical e-commerce site, also adding credit cards, then I add that, and more of that, and make 20 points of retail margin just like I'm a normal e-commerce business. And I can be very selective in finding these $1.50 FlexShoppers that I make on the lease side and be very selective in who I write. So this is a big opportunity to continue to grow our TAM and to be a broader range of customer acceptance on our website. And I was mentioning this earlier, moving that conversion from, the, low singles to, a 300 basis point. It's certainly doable. If you look at the balance of sale for some of these companies that have this kind of credit stack, the lease-to-own piece roughly is 10% of their total business. That second look is roughly 60% of their business. So getting good coverage there, you can increase sales by 6x. Now, I'm not making the $1.50 on the lease, but I'm making 20 points of instant cash margin, just, like any other e-commerce. So this is a big priority for the company for this year. Talking about the margin. So we brought in a merchandising team a couple of years ago to really, develop our product set. Again, when the company was founded, we had partnerships with companies like Best Buy, with Lenovo, with Ashley, and they were making all the retail margin. Now our average margin is 20%. We're going directly to these brands, and the same sort of pitch that we have to retailers on that underserved credit penetration and getting more sales up is really resonating with the brands, because they're seeing the same thing. They're seeing retailers go out of business, like a Big Lots or a Conn's. They're looking to increase sales in what is becoming a more and more challenged environment, and we are happy to help. So these companies are happy to list with us, and we're buying from them. Again, none of this is taking direct inventory. This is all facilitating directly from their various warehouses, where if we either use their logistics or we facilitate the logistics ourselves but take no inventory risk. And then on the merchant side, Monroe, Tire Kingdom, we're very heavy into this automotive space. We actually just started doing business with Pet Boys, with Meineke, again, doing work that is more on the durable goods side versus the service side, because we don't have this lending program right now. But as we get the lending program, then we can go into the servicing side of the bays and do oil changes, do car repairs, actually go into the various auto dealers and be able to then do both service as well as, adding tires there. And there's been a lot of interest from that side of it. In fact, there's a bit of a FOMO because, we are the exclusive, financiers on subprime for Mavis, who are very acquisitive, and they're buying a lot of different companies out there. Monroe actually came to us looking for a new partner because they saw how successful Mavis was doing with our particular program. And, one big thing that we have here, again, is with these merchants, as we acquire customers into the ecosystem, then we are then marketing them to the website, where then they get those repeat customers. We'll approve somebody for $2,000. They'll spend $1,000 at the tire shop. Typically, they're not going to spend the next $1,000 at the tire shop. They're going to come back to the website, use that open to buy to make purchases of a PlayStation or a television, a couch, et cetera. So it's a nice ecosystem. And then this isn't a part of our projections, but this is a bluebird that we have. So in 2018, we filed patents that were around the electronic transmission and underwriting of lease-to-own. And We are currently suing two of our competitors, Upbound Group, which is the parent of Acima, and Catapult, who is primarily online, who do the Wayfair second look program, for violation of these patents. This is being handled on our side by Quinn Emanuel. If you know anything about patent law, these are very highly regarded. In fact, I think they were rated one of the meanest law firms like 5 years running. So they don't need our business, but they see the merits of this case. And one comment typically is, okay, well, these can drag on for years. We chose these two companies because they are actually headquartered in the Eastern District of Texas, which is what they call the rocket docket. So they will speed along these cases quickly. We already have court dates. We expect different resolutions of these cases in the next 12 to 18 months. Again, if any kind of proper successful outcome of this could represent multiples of our current market cap. Again, we're not projecting anything in our guidance, but this is an underlying unreserved asset that we have access to. So that is the end of my prepared remarks. Happy to take any questions.
Do you either finance the leases and loans from your own balance sheet, or is it all third-party things?
So we use a credit facility, waterfall asset management, and it's an ABS type structure on a revolver. There's a question back here. Yeah.
Like changing conversion on the website, going from 25 basis to 8%, isn't that like a good ask for some of the docs?
It would be normally, but in essence, the reason why customers are not converting on the website is that effective interest rate. So if we're charging $2,000 for a $1,000 product over 12 months, in essence, it's 100% rate. That second look, the interest rate's going to be more like 36 with longer promotional rates. So our product has a 3-month interest free, a 36% month at a 12-month, 18-month interest free. Then all of a sudden, the conversion is a lot higher because the price that you're charging for the financing is much more in market. And those customers, we see the FICO scores, we see them apply, but then they don't get the kind of pricing that they want. So getting more folks in our lending tree to be able to handle that, the conversion, just looking at balance of sale of other models, you see a giant increase. So we see some of that, but our coverage of that second look is not quite complete yet.
How do you think it'll work? Like, have you got your own services, like that, is that coming?
Yes, so we will sell personal units, so like HVAC, doing more of like a B2B2C HVAC unit. Generally, the price is higher than what we'd be willing to lend to. Our max credit line is $3,000. So there is a space for that. And if we handle that second look ourselves, which is something that we're actually considering, then all of a sudden that kind of thing comes into scope. And then it's all about getting the right partnership on selling that out into the marketplace. Okay, I'm getting flashed, so thank you very much.